It's a good place to come back to when we inevitably will see a big correction in the gold price, because that buying happened for primarily two reasons. You could dissect it and get more complex, but to keep it simple,
Yeah.
central banks started buying because of two main assumptions, right? The first assumption was that the US government was going to continue to devalue the US dollar. So if you still believe that to be true, then gold's still a good bet. And the second assumption was that United States geopolitical strategy was going to be less certain than it used to be, right? Confiscation of treasuries, all of this.
Jaymartin explains why central banks began accumulating gold so aggressively and why their motivations still matter today. He notes that the surge in official sector buying was rooted in two core assumptions. First, the U.S. government would continue to devalue the dollar over time, making gold a superior long-term store of value. Second, America's geopolitical strategy had become far less predictable, introducing new risks related to sanctions, asset freezes, and the security of dollar-based reserves. Those two forces pushed central banks toward gold as neutral, uninflatable collateral. Martin argues that when the following major correction comes, because all bull markets correct, these same underlying reasons will remain intact. If you still believe the dollar will weaken and geopolitical trust will fracture, gold's role stays essential. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
It's funny, right? Just looking at a gold chart right now, it's almost like you're looking at fantasy, given the false starts, the extended bear market, everything that gold investors have lived through. But it's for investors that have only been in the sector for 2 and 3 years, they're also there, right? They went through a couple of years of pain just to get here. So you don't have to be, 10 years deep in the sector. But yeah, it's a couple things, right? And one thing I've noticed, and you've probably seen this too, is that gold investors who have been in the precious metal sector for, like I said, 3+ years, that's it. They have so much PTSD from how hard the bear market years were that they forgot what a bull market feels like. And as soon as they hear any mainstream personalities start talking about gold, they immediately assume, oh, this must be the top, because the generalist investors are now talking about our sector. This must be the top. It's time for a big correction or a pullback. And, there will be corrections along the way, but it's so almost comical that it's been so long since gold has been favorable that gold investors forgot that's actually what a hot market feels like. It's when generalist investors do begin to turn their head to your sector. And the gold market's different, right? Like a lot of generalist investors that I talk to are watching gold's rally, and they chalk it up to just like the next asset rally. Maybe they watched real estate, they watched crypto, they watched AI, and now they're like, oh, gold is the next asset to rally, and that's what this is. But obviously, gold is different in that good news for gold investors is bad news for pretty much everybody else, right? That's sort of like, it's the smoke signal, and it's emblematic of the shifting geopolitical landscape that we're moving into, right? We're moving from an era of certainty and into an era of uncertainty. And, we can obviously unpack that. But for anybody invested in the gold sector, specifically the equities, I would say, when the market hands you a gift like this and there's a bit of froth in the equity prices, just make sure you're taking care of yourself, which means take profits, right? Never be scared to take profits. Take a bit of risk off the table, especially if you're in any sort of earlier stage opportunities, and just reallocate that cash to something more secure. If you look at any of the best investors in the gold sector who have been around 20, 30, 40 years, many of them are probably not much better buyers than anybody else, but they're much better sellers. They're quick to take profits when the market hands them a gift. And so, that's one thing I'm doing in this precious metals market, is de-risking from anything that's, on the sort of medium risk to high risk side, and just reallocating that capital to a longer term bet. It's a good place to come back to when we inevitably will see a big correction in the gold price, because that buying happened for primarily two reasons. You could dissect it and get more complex, but to keep it simple, central banks started buying because of two main assumptions, right? The first assumption was that the US government was going to continue to devalue the US dollar. So if you still believe that to be true, then gold's still a good bet. And the second assumption was that United States geopolitical strategy was going to be less certain than it used to be, right? Confiscation of treasuries, all of this. So as long as those two assumptions are still in play, the gold thesis is still in play. And that's why it's valuable to look back at the central bank buying as your primary catalyst. It is that is the big shipping money, right? The slow to move, slow to pivot capital. That's the central bank treasuries. And everything after that, right, follows this gold market has been the most textbook market anybody could expect, in that it started with central banks buying the physical
Right.
asset and the physical asset appreciating. And then over 6 months, 9 months, some of the best in class royalty companies started appreciating. And then 6 months later, the best in class miners. And now it's like the funded developers, and some earlier stage stuff is getting some love, but it's been, 3 years of slow, methodical, patient capital trickle. And investors are always impatient, and they're like, but when are the junior equity is going to catch a bid and all of this? And honestly, that gives me anxiety just to think about, because it shouldn't be easy to make money. It should be hard. But the slow approach that this gold market has rolled out is so textbook and gives me a lot of conviction in the longer term trend.
Jaymartin reflects on how sentiment has shifted dramatically within the gold sector. After years of false starts and a grinding bear market, many investors who only recently entered the space are already carrying psychological scars. So much so that the first sign of mainstream attention feels like a warning, rather than confirmation of a genuine bull run. Martin argues that this reaction misses the point. A healthy gold market requires generalist capital to rotate in. He reminds investors that corrections will inevitably occur, but disciplined profit-taking and reallocation into stronger long-term positions are what distinguish seasoned operators from emotional traders. Most importantly, he notes that the entire rally began with the slow, deliberate accumulation of physical gold by central banks, still the clearest signal of a durable trend. Now let's get into the interview.
I think we have, 5-10 years of a gold market in front of us. There are certain companies that I'm comfortable parking capital in for that duration of time, knowing that inside 2 years, inside 5 years of a secular bull market, there's going to be periods of terrifying volatility. But the companies I'm comfortable parking capital in through that volatility are the cash flowing, the Agnico Eagles, the Newmonts, the Wheaton Precious Metals, these companies, right? They're managed well, great quarterly earnings. They're profitable. If gold drops $1,000, it's still a good business. And I'm comfortable riding out the long-term trend in a vehicle like that. But a lot of my viewers and probably yours also invest in the speculative side, right? Now, these are companies that don't have cash flow. They're not really businesses yet. They're companies that you invest in, and you're waiting on a catalyst that may shift the share price, right, favorably, right? Well, one of those catalysts just arrived. That's market sentiment. And so share prices are up, and I'm in a handful of, WhatsApp investing groups and trading groups, and I'm watching people celebrate 300, 400, 500% gains on a speculation, and they're not selling because they have some price in their mind they're waiting for. And it's like, no, this is the time to take that principle off the table, right? You can wait out a secular bull market with the volatility in a healthy business that has great quarterly earnings and pays a dividend like an Agnico or a Wheaton, but you can't just set it and forget it in the speculative market. You got to pay attention to those catalysts, take the opportunity to de-risk when it's served up to you, which it is right now. And so that's how I differentiate between those two. One I'm comfortable parking for the long-term secular bull. The other, you just have to be a little bit more on top of. We're seeing the China playbook enter the West. We're seeing the marriage of state partnership with private enterprise, and the 10% equity deal in Intel, the 15% equity deal in MP Materials. The United States government is now the largest shareholder of MP Materials. 5% in Lithium Americas, 10% in Trilogy Metals. The United States government has become the newest investor at the table in the raw material sector. And this is new in the West. And it makes us uncomfortable because as a small business entrepreneur, a free market guy, I don't want the government in my business.
Right.
But the government doesn't care what I think, and they're going to do what they do. And they're doing this. This is the future. I firmly believe that we're going to see more state intervention in private business in the West, because from a competition standpoint, if you were to break down the global economy and look at countries as corporations, the China corporation has been leveraging this strategy, and it's worked very effectively. And now the United States corporation is going to try and replicate. The question is it going to work, right? Can the U.S. actually reshore to the extent that they want to? And the part of this conversation that almost nobody is talking about is the
Right.
cost. The cost of reshoring these major industries and reindustrializing the United States. I mean, China did this over the last 30 years, and it cost them trillions of dollars. The United States is now going to attempt a version of that, but in today's dollar terms. We're not talking about hundreds of billions of dollars invested in manufacturing over the next 10 years. We're talking tens of trillions. And the inflationary impact of reshoring these industries is going to be a phenomenon that we've never seen before, especially if they try to do it quickly, right? And this is a major part of the conversation that's missing, but there's no two ways about it. And keep in mind, when China industrialized, the whole world wanted them to do it, right? Everybody signed that contract. We wanted the advanced technology. We wanted the EVs, the TVs, the smartphones, the laptops, but we didn't want that very specific part of the supply chain, the dirty part, the refining of the
Yep.
minerals. So China raised their hand and said, we will take that on. We will cede environmental considerations. We will leverage our cheap labor so you can have your cheap iPhones. And everybody signed that contract. And we may not like that contract today, but it was signed decades ago. But the world wanted China to industrialize so that we could globalize efficiently and have access to cheap goods. Nobody wants the U.S. to industrialize because all that does is heat up the trade war, increase the era of uncertainty in the supply of goods and services, right? It's not good for economies outside of the United States, right? Now, they're still going to do it, and they should because it's in America's best interest, but it's not in anybody else's best interest, right? I mean, everyone else is primarily concerned about one thing, and that's their people's safety and their people's prosperity. This BHP deal that happened at the end of September, when everybody was talking about rare earth elements and these restrictions, the headline that far fewer people were talking about was China made a different announcement that same week. And it wasn't about rare earths, it was about US dollars. They went to BHP, one of the world's largest commodity traders and supply companies based out of Australia, and they halted future orders of iron ore in US dollars. They didn't halt future orders, just orders in US dollar terms. And China orders about $75 billion worth of iron ore from BHP every year. So it's a big order, and this brought BHP to the negotiating table.
What we're witnessing now is the collision of two massive forces: a decade-long precious metals bull market forming beneath the surface, and a global economic realignment that is forcing governments and corporations to rethink their entire supply chain strategy. Jaymartin argues that long-term winners will be the businesses with real cash flow and durable margins. At the same time, speculative names demand active risk management, especially now as sentiment alone is pushing shares to extremes. At the same time, the U.S. is adopting a playbook that once belonged exclusively to China: state-backed stakes in critical mineral companies, large-scale intervention, and efforts to reshore entire industries. But unlike China's rise, the world does not want America to reindustrialize, because doing so fuels inflation, intensifies geopolitical friction, and accelerates the shift away from the dollar. In that environment, tangible assets take center stage. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.